Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, November 6th, and we'll see how things look for Friday, November 7th. Going over the action in Thursday's session, the S&P 500 closed down 1.12% on above average volume, finishing below the psychologically significant 67.25 level after a wave of late-day selling. The S&P opened lower, broke through both S1 at 67.68 and S2 at 67.30, found temporary support near 67.08, staged a modest rebound to 67.50, a round number which is acting as resistance, before rolling over into the close. From a trend perspective, the short-term trend has now turned negative, prices below both the 20-period simple and exponential moving averages. The intermediate-term trend remains positive but is clearly weakening. Price is still above the 50-period moving average. The long-term outlook remains bullish with price well above the 200-day moving averages. Looking at key technical signals, several important indicators flipped or confirmed bearish shifts on Thursday. The Parabolic SAR has flipped to bearish. Another Hindenburg Omen spike was seen on the chart and a cluster is now forming. And the Stochc RSI is in extreme negative oversold territory, the only momentum indicator so far showing negative conviction. On the daily side, the S&P 500 broke the November monthly pivot and is now testing S1 near 67.20, a level reinforced by gamma exposure support levels. Looking at growth versus value and mega cap leadership, growth stocks underperformed on Thursday. The large cap growth to value ratio has fallen below both its 50 and 200-day moving averages. Mega cap names led the decline, confirming rotation out of high valuation leaders. As far as sectors, the winners include the defensive areas such as energy and healthcare. Eli Lilly was helped following a Trump administration announcement on drug pricing reforms. The losers were mostly growth-oriented. This includes tech, communication, discretionary, which ranked at the bottom of performance. The financials continue to underperform the S&P, even though it bounced slightly on Thursday. Real estate and materials also continue to lag. Looking at market breadth and sentiment, the advanced decline lines are declining on both price and volume. The AD oscillator sits below zero. New lows are expanding while new highs are contracting. The VIX rose but still remains below 20. However, the VVIX, or volatility of the VIX, is picking up. Put-call ratios actually ticked lower, suggesting less hedging than expected, possibly due to positions being unwound. As far as investor surveys, Evercore ISI reports 76% of clients expected the market to climb 10% when the survey was taken on Halloween. With this high reading, this is often used as a contrarian bearish signal. The weekly AAII sentiment is neutral to slightly bullish with a net reading of 1.7. As far as technical indicators, all three smart money indicators continue to be negative. As far as the macro and fundamental outlook, the 10-year Treasury yield fell to 4.09% from 4.16%, a potential flight to safety move. The U.S. dollar index did pull back and has now dropped below 100. As far as economic data, the challenger job cuts surged to 153,000, concentrated in tech, which might be AI-related layoffs, as well as warehousing. No government data was released due to the ongoing shutdown. Even with the recent declines, valuations still remain elevated. The forward PE is currently residing at around 23. However, earnings growth continues to rise year over year. Comparing seasonality with reality, November is historically strong, particularly November 7th, which has been positive for the Dow, S&P, and NASDAQ going back to 2002. However, positive seasonality failed on both Tuesday and Thursday this week, despite the upward bias. The market is currently ignoring seasonal tailwinds. Looking ahead to Friday, November 7th, the technicals still show the Stochc RSI as being extreme negative. Gamma support sits around the 67.20 level, aligning with the daily S1 pivot point, but caution is warranted. We're starting to see a series of lower highs and lower lows on the daily chart and persistent late-day selling momentum. A building Hindenburg Omen cluster is also of concern. As far as the data being released, The preliminary reading of the consumer sentiment will be released at 10 a.m. Eastern. In conclusion, the short-term trend has now switched to negative and is gaining conviction. The intermediate and long-term trends still remain positive, but possibly vulnerable. We're seeing a growth in defensive rotation, mega-cap weakness, and a continuation of confirmed Hindenburg signals. The buy-the-dip reflex failed on Thursday, as the smart money was selling going into the close. Thank you very much, and I will talk to you in the next podcast.